Good morning and welcome December 6, 2024 to the Length of Service Awards Program, otherwise known as LOSAP. My name is David Weiskopf. I am the chairperson and county administrator, and we'll start as we always do with introductions. To my left,
Vanetta Van Cleve, CFO for the county.
John Walter, Citizen Representative.
Scott Ostro, County Commissioner.
Catherine Pratson, Board Member and Director of Human Resources.
Joy Sapp, Plan Administrator, Deputy Director of Finance.
Dana DiGregorio, Administrative Recorder.
welcome everybody. And next up is the approval of today's agenda.
I'll move to approve as presented.
Second.
I have a first and a second. All those in favor signify by saying aye.
Aye.
Ayes have it. Motion carries. Next up is the approval of the October 25th meeting minutes. Are there any additions, corrections, deletions?
I move to approve the October 25th meeting minutes.
I'll second.
I have a first and a second. All those in favor signify by saying aye. Aye. Ayes have it. Motion carries. Rolling right along into our presentation, Mr. Patrick Wing of Marquette Associates for the Quarter 3 Investment Performance Report.
Yes, sir. Thank you, Mr. Weiskopf, and good morning, everyone. And just want to apologize for the temperature of the books. They were in the back of my car last night. Hopefully, they're beginning to thaw out a bit. But with all that said, as Mr. Weiskopf alluded to a second ago, we'll start with the third quarter performance report. And as always, if you can grab Exhibit 2 and flip that over, we'll start with a quick update on the market environment, specifically what's going on in the economy, capital markets, to provide a little context for how and why the trust performed the way it did during Q3. So on page 10, as always, starting up the top left, start at a high level from an economic perspective and then get a little bit more granular here. But we know in that top left bullet point that economic growth remains strong in Q3. You can see in that second and beginning of third line, real GDP increased at an annual rate of 2.8%. So that was the first estimate that we got at the end of October. We have since got a second estimate at the end of last month, and it stayed at 2.8%. Now, for some context, if I can draw your attention to the top right graph, that shows economic growth going back over the past couple years, where the bars are the quarterly figures. The stripe bars to the right are economist estimates as we close out this year and head into 2025. You'll see that last fully colored in bar shows Q3. So a slight deceleration from Q2, but reasonably stable from a quarter ago. And looking ahead here, you see those stripe bars. Economists estimate a slight deceleration in growth there, but still pretty steady, kind of around the 2% range that most estimate as the underlying trend growth rate in the economy. So we continue to remain in this environment where economic growth has remained fairly steady, fairly strong despite higher rates. And we talked a lot about that over the past year, namely interest rate sensitivity or the lack thereof amongst households, given their balance sheet profile with predominantly comprised of fixed rate mortgages, a lot of larger corporations terming out their debt when rates were low. So a lot of fixed rate debt on the balance sheets of households and corporations not really impacted by higher rates. And then the second component, what's going on the fiscal side of the equation, namely that the fiscal deficit at the federal level remains pretty high given where we are in the economic cycle. And you can see some of the impact of that across the economy, and namely the labor market down below in that second chart on the bottom of page 10, specifically where the job growth has been since COVID. So if we start to the left of that chart, you can see where the sectors that have done the best. You see construction there, and that's a little counterintuitive at first glance because we know residential housing market has been under some pressure given higher mortgage rates. But if we think back around a lot of the fiscal initiatives over the past couple of years, the CHIPS and Science Act, Inflation Reduction Act, really around themes of reshoring, onshoring, building semiconductor manufacturing facilities within the U.S. So a lot of those are commercial construction jobs. And then to the right of that, utilities. Well, we're going to need a lot of power generation for that type of a new manufacturing and work initiatives within the U.S. And then the third one, education and health services, another sort of quasi-government related sector. So you can see the fiscal impact in the labor market given the areas that have done the best amid a lot of those initiatives. Now, if you go to page 11, shifting gears a little bit, just want to spend a quick second on the labor market and inflation and then relay that to how it may impact Fed policy moving forward here. So up top to the chart to the right, what we're showing is a couple things. Number one, in the brown line, the sort of supply and demand balance within the labor market, and that's normalized more recently. So that brown line is defined in the legend in our job openings, or sort of the demand for labor divided by the unemployment level, or the supply or workers looking for labor. And you see how it spiked post-pandemic there, and then has normalized over the past couple years. At the very end of the chart, that brown line is almost in line with its sort of pre-pandemic peak. But in sympathy with that, the blue line shows core inflation excluding energy and food prices. You can see rose in sympathy with that tighter labor market and has since decelerated as things have normalized, not just from a labor market perspective, but a supply chain perspective as well. And amid that environment of normalization, we've seen the Fed start to cut interest rates. We talk a lot about that below, but things have changed more recently, so I'll just speak to what's going on. So the Fed cut rates for the first time by 0.5 percentage point in September, cut rates again by 25 basis points in November. They meet again in a couple weeks. As of yesterday, the market was pricing in about a 75% chance that they were going to cut again by another 25 basis points. That's changed materially just this morning because we had the November jobs report come out. That was reasonably strong, but what it did was cause the uptick in the probability of the Fed to cut rates from about 75% to around 90%. Which was interesting given the data. The jobs report showed around, I think it was around 240,000 jobs when the estimate was about 220. But what we saw was a big snapback from the previous report that showed only around 12,000 jobs. That was revised higher. Remember, there's some hurricane-related effects. We had some strikes going on. So it was kind of a number that was somewhat suppressed by that. So when you look at, say, the three-month moving average, that kind of removes some of the distortions. That's moderated from earlier this year. So despite the really strong report this morning, the market's kind of looking at the 3-month as more of the trend, which has decelerated to some degree. And in the market's head, that's giving the Fed some latitude to cut rates once more in December.
Is that number, that report, one of those reports that you wait a couple of weeks and then it gets corrected or adjusted? Or is this it?
Yeah, it gets corrected and adjusted many times. So what happens is, so they released the report today for November, and they always revise the preceding 2 months. Okay, so what we saw for then October and September in aggregate, those numbers were revised actually upward by 56,000 jobs. So it's kind of in the next report, the previous 2 months will be revised, but then once a year, they will do annual revisions as well and try to line up, because the initial jobs report, let me back up for a second, it's largely based on surveys, right?
So eventually the predictability of a rate cut and the jobs numbers, they do kind of come together with real data and real predictions.
Eventually, yes, but when we get we'll get the revisions for the preceding 2 months always with this month's report, but the annual revisions occur once a year. I think it's in March or April. So annual revisions meaning for the preceding year. So that at that time it's so dated that it probably doesn't have much of an impact unless the revisions are well outside what people are expecting. Because when you get those annual revisions, what they're actually doing is, instead of doing a survey-based measure, which they do every month, right? So, I mean, think about that. We're, 6 days into December, and they're trying to report all the jobs created across the country. It seems somewhat of a fool's errand, but in that annual revision, what they actually do is try to match up from a tax reporting perspective, who has jobs, who doesn't have jobs. So you have sort of actual data that there's some extrapolation from, but they have the actual data to use those revisions instead of just being based on the survey itself. So when you think about those monthly reports, think about it more not just the number itself, but more from a trend perspective. And that's what the markets are really looking at. So the past 3 months, we've seen a little deceleration. So in turn, the markets are thinking the Fed has more latitude to cut in December and then another couple of cuts next year as well.
Thank you.
Yeah, of course, of course. What's interesting about that too, we talked a little bit about this yesterday, is even since the Fed cut rates first in September, yields are actually higher since then, because a couple months ago the market was pricing in even more and more rate cuts. And since the economic growth data remained reasonable, coupled with the inflation data more recently has been a little worse than expected, some of those rate cuts have been priced out and yields are a little bit higher. So we'll see in a second here. Fixed income was quite strong in Q3, but it's since reversed course a little bit here in Q4, just given how the data has come in. It's changed those expectations around what the Fed may do, not just in December, but through all of next year as well. So with that said, that's probably a good segue to page 13. Just talk quickly about markets here. And it was a strong quarter, really any way you cut it. So on 13, we'll focus on the green bars. Start up top in that chart to the right, where you see the U.S. equities, developed non-U.S. emerging market equities, returns ranging from, we'll call it 6 to about 9%, where emerging markets led the way for the second consecutive quarter. Now, that wasn't the case for much of the quarter, but they experienced a very strong rally in the last maybe 7 to 10 trading days of the quarter, in the wake of a pretty decent raft of stimulus announcements coming out of China, which caused a big rally in Chinese equity markets. And China comprises around 25-30% of the entire emerging markets universe. So that led EM leading its developed market counterparts for the second quarter in a row. U.S. bonds there, fourth row down, you see a very strong return for fixed income. Those are investment grade bonds up north of 5%. So again, as the inflation data in Q3 was a little bit better, not like Q4 that I just spoke to, and the expectations for Fed rate cuts were building, that put downward pressure on bond yields, putting upward pressure on bond prices. As far as some of the other asset classes in the low SAP, 2 rows below that, you see high yield bonds marginally ahead of investment grade bonds. So the fact that they outperformed investment grade bonds is not surprising. It's a little bit more of a riskier fixed income class, and it tends to do better than investment grade when equities are doing well. But the magnitude of the outperformance is probably a little less than you would have expected. And the reason behind that is the interest rate sensitivity, or the duration of high yield bonds, is less than investment grade bonds. So as rates fell, high yield didn't get much of a kicker to the upside as investment grade. So they were marginally ahead, and we would expect that given equities were doing very well. But the magnitude of outperformance relative to investment grade was probably a little less than you would have expected outside the interest rate impact. A couple of the other asset classes a little further down the page, you see tips up from the bottom there. They were also quite positive, up a little north of 4%. They did underperform investment grade bonds by about a percentage point. That's because inflation expectations declined a little bit during the quarter, much like my comments a couple minutes ago on how rates have backed up a little bit more recently. Inflation expectations have ticked up a little bit more recently. So this quarter, they're actually ahead of investment grade bonds. And then the other two asset classes in the trust, global listed infrastructure, U.S. REITs, also posting gains between, call it 14 and 17%, pretty strong returns for those asset classes. So as we'll see in just a minute here, pretty much all asset classes across the board here, and those particularly in the trust did quite well. So we had a very strong absolute return, which we'll note in just a minute. But before getting there, if you just want to go to page 15 quickly, just want to talk a little bit about what's been happening more recently, and maybe a quick peek ahead into next year. And what's interesting around these data, and we'll just focus on the two charts, starting with the one up top. We did some work going back to 1984 there, Q4 returns in presidential election years. And what we found was that you'd seen that gray bar, that the return in those periods from October 1st through the close of business on the election day was relatively muted. And, intuitively, it makes sense, right? So we have a big event coming up, markets hate uncertainty, a little bit of choppiness, a little bit of volatility. But then once that event is out of the way, right, it clears, things tend to calm down a bit and markets tend to rally through year end. And that's pretty much what we've seen so far. Through election day, U.S. equities were up around 70 basis points, so not too dissimilar from that gray bar. And since then, they're up quite a bit. So far, quarter to date, I think the number's around 6.5%. So the magnitude of the return, certainly higher than history would suggest, but directionally very much in line with these data themselves, where things were choppy, a little bit more muted. And then once things were over, we saw a
Do you see
decent rally.
that continuing now that there's a new administration coming in who are twofold on my question, because, you know, they are saying they're going to impose tariffs and things like that. Do you see this increase continuing, or do you see it coming back if?
So I think that's a good segue into next couple of comments, and I'll weave in some other commentaries. So number one, if we think about things just from a calendar-based perspective, like we're doing here, we're right now in the middle of the best 3-month period, at least historically, since 1950 for equities, from November through the end of January on average. Equities have returned around 4.5%. We're well above that right now, but history would argue that over the next 5-6 weeks, we're at least probably going to be in a somewhat stable environment, maybe grind a little bit higher. But as we look ahead, if we look at the bottom chart, one of the things to note is if we take a more intermediate term view and look at these presidential cycle returns, which I think are important in the sense that they show a pattern that is followed suit generally over time with certainly some variation, but they're not the only thing we look at, but they stayed pretty true over the previous 4 years. And what I mean by that is if you look at year 1, 2, 3, and 4 there in the horizontal axis, note that we're exiting year 4 now, obviously, but year 3, year 4, by the historical data, you can see highest returns. Those green dots show the highest probability of positive returns. Those are on the right-hand scale. And we're about to enter year 1, year 2, and historically, they've been more subdued. A lot of sort of the theory around this is, once year 3 kicks in, we're hyper-focused when the president is hyper-focused on election, trying to boost the economy, stimulus, the markets to follow suit. And in the beginning of the term, really focus on, more policy proposals or what's most important, which may not always be economically focused. And then as you get further into the term, rinse and repeat. So the data here would say that, once we sort of exit the short-term period, we may be in for some more choppiness and volatility. And the other thing to note, we talk a little bit about this in this bottom bullet point here, it's also always important to note, and valuations are a horrible timing tool, but the fact of the matter is towards the latter half of that paragraph, where it notes the forward price to earnings ratio is around 22. So that means, what's the price of the market today relative to what analysts expect earnings to be over the next 12 months. And that's notably higher than the 10 and 20-year averages there of 18.8 and 16.3 respectively. So when we think about that, if we're overvalued, and again, valuations are a horrible timing tool, but it just gives you a measure of, or a sense of, what sort of bar you have to clear, right? So if you have a pretty fully or maybe slightly overvalued market and some of the data or news, if you will, comes in not as good as expected, then you're a little bit more susceptible than would have otherwise been the case if things were trading more cheaply. So to the tariffs comment, what's been interesting more recently is that in Q4, U.S. equities have done very well, but non-U.S. equities, so non-U.S. developed emerging markets have all returned, I think, about -4% and -2% respectively, where the U.S. market's up close to 7%. So I think that's a lot of, sort of the policy proposals being priced in. We'll see if they're actually enacted, which is what matters, right? Because the expectations right now are that they are going to, but what matters is whether or not they happen, right? And similar to non-U.S., that's come under a lot of pressure because the dollar's been very strong, concerns around tariffs, so those markets have been under a lot of pressure. So that's the expectation, but what actually happens? So we don't know. So to your point, I think, if we look out in the next year or two, the historical data coupled with these valuations would argue that things are, and this is probably a safe comment, that are going to be certainly more subdued, more choppy, more volatile than we've seen over the last 2 years of these, pretty strong returns where we've only seen, mild hiccups along the way. All right. So with all that said, if we want to go behind the next exhibit, we can walk through the data here somewhat quickly since we covered a lot of it in the update. But on page 22, the update that we covered in October, on page 22, you see the market value at the end of September. We'll have an up-to-date figure to share shortly here, was $18.5 million. See a net investment change of $1.1 million. And a return of 6.6%, which was in line with the policy index, which we would expect because we have a lot of, it's predominantly an indexed portfolio. So that said, there were some things that were helpful for the trust relative to the policy index and some things that detracted. So what was helpful under positive attribution, asset allocation, meaning that we had more money relative to targets in places that did well, like equities, and we had a little bit less money in places that lagged a little bit, like fixed income. Also, you can see there the high yield bond ETF outperformed its benchmark. But on the negative side, we had Principal, the active REIT manager there, underperformed slightly. I'll talk more about that later on. And then fair value pricing, particularly in emerging markets, and talked about that in the past, just the differences between how the mutual fund prices and the benchmark prices, which washes out over time, but in the short term, it could cause a negative or positive impact. And then looking ahead, when we get to the recommendations, the quarterly contribution, the next quarterly contribution for fiscal 25 was made earlier this week, so we'll talk about the recommendations for that rebalancing. So on page 23, just quickly, some of the high-level information here, and then we'll get a little bit more granular. You could see up top, the third quarter in that top table, all the way to the left, we began the fiscal year about 17.1 million. You had a net cash flow of about 243 grand, so we're putting in 250, so those are just nominal fees that that the plan administrator report goes through at every meeting. And then that on top of the net investment change left us about 1.37 million higher than where we began. So you see more returns in the middle of the page there. As always, we'll cover these in just a second in more detail from the peer perspective, but always worth noting in the bottom table, asset allocation versus target all the way to the right, where you see within range and yes and green up and down across the board, just confirming that we're in compliance. So in other words, all the permissible asset classes are within their permissible respective ranges per the board's approved investment policy statement.
Can I
with
ask
that-
a question?
Oh, yes,
Back-
sir.
Back to that, just please remind me, and I apologize, because, we sit on 3 different boards that are a little different, but we're like 35% for U.S. fixed income. It seems high to me, and I'm just trying to remember the reason.
Yep. So when you think about, so there's a couple of things. So the 35% fixed income is high compared to peers, but that's because we have a low assumed rate of return of just 6.5. So if you were, Mr. Osler, you weren't here yesterday, or Commissioner, Greg Stump from Boomershine was here yesterday reviewing the SORP actuarial evaluations. One of the comments he made was around his clients, sort of the average discount rate that they use as that he sees as a little below 7. What we see is the median's probably around 7, if not incrementally higher. So we'll call it 7, right? So when we're shooting for a lower assumed rate of return, it means that we don't have to be as
risky,
aggressive
right.
to get that, which especially now, when you were early funding it on, putting it in very low funded ratio, then you probably wanted to be a little bit more aggressive to not just have the contributions help you get to a better funded status, but higher returns alongside that. But now we're, much better funded. I believe Mr. Stump, did he present on the LoSAP earlier this year?
did.
And I think the funded ratio was around mid-70s, I think, right? So we're so much higher. So it was 75. So we're so much higher now, so we can have sort of a mix here that's consistent with that assumed rate of return.
Look, with other people's money, I'm very happy to be conservative.
Oh, yeah,
right?
yeah.
I certainly, and I mean that with all sincerity. I just wanted to refresh my memory.
So what we did, if you recall, the timing will escape me, maybe 2 or 3 years ago, the fixed income bucket after rates have risen rather materially, that's painful in the short term, right? Because yields up, bond prices down, but it's actually helpful going forward because much higher yields means much better fixed income returns. So we did asset allocation analysis and study, and something that we'll do on a regular basis, every couple years or when circumstances change. But at the time, we showed that this mix was very much consistent, actually probably incrementally ahead of that 6.5. But those are the things that drive this, right? Sure. What's the target? What are the flows? Things of that nature.
Well, thank you.
Of course. So with that said, if you want to jump to page, 26 here, I think that's actually a good segue to this next section that we talk about regularly, the peer review, where we see, again, all the way up top, the graph showing a universe of funds, public funds less than $50 million. So as you know, the chart up top is just the graphical representation of the first table there. In other words, the distribution of those returns. But where we're really focused is those bottom two rows in the bottom table where you see the circle and the triangle there. So if you go to the first column, you see those two 6.6% returns I spoke to earlier. So with fixed income doing very well, traditional assets doing well, that means that the LoSAP was in the top 13% during the quarter. So a pretty strong return from an absolute and a pure perspective during the quarter. But to your comments, Mr. Weiskopf, as you go to year to date and 1 year, kind of oscillating around the median. Well, why is that? Because we have more in fixed income, right? And fixed income hasn't done as well or nearly as well as equities, which are up 35% or something like that. And that's probably a similar story for the 3-year period, which encompasses the time where we made those policy changes a few years ago, which included decreasing the REIT allocation, changing some of the regional breakdown and things like that. And so the board's discussions and openness to making some of those policy changes, you can see, have been helpful relative to, say, the the 5 and the since inception numbers, which leave a little to be desired, obviously. One of the things that is interesting, I think, too, sometimes we talk about, if we have a fully indexed portfolio, which has been fully indexed too until, we were fortunate enough to begin working with you all for the 5-year number, why are we kind of behind, right? So obviously I can't fully answer that since we weren't working with you all, but if you go to page 28, what we can kind of try and figure out is, on the bottom right-hand chart, so the smaller chart in the bottom right, what this is showing is the excess performance of the fund versus that policy index. So obviously, if that bar is above 0, the fund's outperforming and vice versa. If it's green, that means it was a up market and vice versa for red. So if you go back to the first 4 or 5 quarters there, you can see there were 3 pretty big periods of underperformance in strong markets. So I don't obviously know why that occurred, but if you recall, a few years ago, we increased the frequency of the meetings going from 4 to 6. So I suspect doing that has been helpful more recently and not having these big outliers because we have the contributions, we're reviewing it more regularly, we're rebalancing more regularly. So I suspect in that time period, it may be just what they call an implementation lag, right? If you're not meeting frequently, rebalancing, and in volatile markets, things can move quickly. And if you're not taking action, something like that could happen. So that's my supposition. I don't know that to be true. But increasing the meeting count just from 4 to 6, as you can see to the right of that, we're kind of oscillating above and below that flat line in both good and bad periods, which is what we kind of expect because we're meeting more frequently. The contributions are going in, we're rebalancing more frequently. Everything's fully indexed, so we should be tracking it reasonably closely. So hard to say what was going on, in kind of that late 2019, 2020 period, but different, practices via the meetings and via the quarterly contributions instead of just one lump sum is helping us keep things more in line and tracking what we want, right? That sort of policy index more closely over time.
And I don't think, Pat, until recently, I don't think the commissioners funded the trust all the time either. Mm-hmm. And that's been a recent, progress. Mm. So
yeah, and to that comment, and I believe this was Mr. Walter's idea, as opposed to just lumping everything in all at once, doing a dollar cost average. It's sort of rightfully forcing our hand to some degree, or maybe imposing a very disciplined approach.
And it's
right?
been a little bit more predictable.
Right, exactly. So you have a myriad of things of sort of thoughtful decisions the board has made from an administrative and operational perspective that leave the probability of what happened 5 years ago happening again, de minimis.
Yeah.
Is that how long Marquette has been with us? 5 years?
No, we're coming to the end of year 4. Is that right? So beginning of 21, I think it was. Yeah. Maybe it's felt like 5, Mr. Walter. I don't know. or maybe longer.
But you're coming soon to having to take full ownership of all that.
That's
Point.
So with all that said, if you want to jump to 29 as I look to wrap up here, and this will be relatively straightforward as, again, everything's largely indexed here. So on 29, you see up top are the total fund returns again. And then beneath that, the various asset classes. So you see U.S. equity in line with the policy index there, both at 6.2. Again, we're using an index fund, so we should fully expect that. Same with developed non-U.S. index fund, both at 7.3, where you see the fair value pricing impact that I spoke to earlier. Down below, the emerging market is at 7.7 versus 8.7. So again, we're just using an index fund. Why is it deviating? Again, it's the difference between how the fund prices versus the index itself, and it'll wash out over time. I looked at it this morning, and I think the fund is ahead of the index by about a percentage point. It just washes out. So what was a detractor that we have no control of will turn into a pleasant, kicker to the upside, again, that we have no control over. On the next page, and we'll look to wrap up here, up top, you see the real assets composite. So that's comprised of REITs, infrastructure, and TIPS, about 30 basis points behind the policy index, largely due to within REITs principal there, up 15.5% by about 1.5 percentage points behind the benchmark. It was an interesting quarter in that a lot of more cyclical stocks within REITs outperformed, so things like malls, and other areas that are still under sort of these secular headwinds, and principal being a little bit more of a defensive manager is underweight those areas. So in other words, when the benchmark's up 17%, led by more volatile type of stocks, we would expect them to be behind, which they were. And then the other two spaces, whether it be infrastructure or TIPS there, you'd see with infrastructure largely in line with the benchmark. And then TIPS, the lines are dashed because remember we made that policy change, switching the TIPS fund. So if you look all the way to the right, you can see since it was added, it's in line with the benchmark as we would suspect. And then finally within fixed income, the second last darker line there, you can see, again, similar to the benchmark there, the underlying funds, Fidelity and the active manager Baird, both in line, whereas the high yield bond ETF at the bottom was slightly ahead, so that was helpful. And one of the things I wanted to note as we wrap up, again, we don't have a lot of indexing really, a lot of active managers, just two with Principal and Baird. The Baird fund there you can see has been helpful. It's only been in for about a year. If you go all the way to the right, they're about a percentage point ahead of the benchmark. So again, as the fund continues to grow and the opportunity set increases, we could look and try to be thoughtful in certain areas around maybe introducing some other active management. But as far as still sitting at that around $18.5, $19 million range, probably looking towards maybe when we get to around 25-ish type million to maybe having those conversations. But as always, if we think something makes sense for the boards to consider, we'll bring it to your attention. So with all that said, I will pause there. Happy to answer any questions or address any comments before we move on.
Pretty straightforward.
I have a question. I know that the actuary was just here this year, so I don't know if it's a question for him, for you, or for our CFO regarding where are we now? Was it July of '23 that the new rates or the new benefits went into effect? Have we taken a look to see how that's affected the fund or
I would have to look at the,
actuary report to see if they
Right.
touched on that?
and I seem to recall that it was included in it, in the fact that the benefits had been modified, but we didn't have any experience
Right. We didn't have a
with
full year.
providing them.
Right. I'm just curious
Yep.
how that,
Yep.
affect, if we saw a huge decrease or it wasn't that noted. I'm just curious
Yeah.
what the effect was. And I don't know.
I can certainly pull that report up.
Okay.
Sure.
Just why I'm thinking of it.
Do you recall, Joy? Do you remember?
I don't.
Yeah, I'll pull the report up.
No, not trying to catch anybody. I'm just curious.
No,
Yeah,
sure, yeah.
But I'm trying to remember when the actuarial report was and if it was just too soon to really.
And I think it was similar to the one that was presented yesterday, that Boomersheim was really reporting on the previous actuary's work.
Right.
Because they haven't had the account for long enough you know. to
So
do
maybe
their
it's
own-
going to be in 2 years, we're really going to
Right.
get an in-depth analysis of,
Right.
here's what it's done, right? Which is, just curious.
Yeah, I'll circulate the report for everybody after the meeting.
So Mr. Stump would be back, say, April 27 to do the next LoSAP, right? Do I have that right? Or April 26, I thought.
26.
26,
Yeah.
right?
Yeah, because it's every 2 years.
Right.
Yeah. Yeah, but he'll be back to present OPEB.
Early next year.
Yeah, more recently, so we could certainly have him address, any questions.
Just curiosity's
Yeah,
sake. I
yeah.
just,
No, because it was a significant change in benefits.
It was, right?
You're
I
absolutely
mean,
right. Yep. Yeah, and as discussed again yesterday with the sheriff's office, that salary increase from a couple of years ago for the deputies was so significant that that really has impacted, the valuation.
yeah, I
So-
mean, I forget how long ago, well, it was COVID, right? Because I always joke and say the two luckiest people in Leonardtown was the sheriff's office and that restaurant out there that sold the week before COVID hit. Because they got an 18% increase, justifiably. So I'm not knocking the increase, but it happened a week before COVID, right? And I'm sure we would have been more circumspect to, guard our money.
Cautious,
Right, cautious, right? So, no, it's a good thing.
Yeah. Yeah.
So, anyway.
I'm sorry, could you repeat, when did the benefits change? The
July of '23, we can,
For the volunteers, yes. Yep.
it was, I don't know, it had been the same for maybe 18, 20, for a long period of time. And did we change it in the budget, or did it just simply change by ordinance or resolution?
It was resolution, yeah, it was
We can,
resolution.
we can send you a copy.
Yep.
Copy of that, and
Yep,
Thank you.
yep.
it
And it was
was like,
going forward, it wasn't anything in the rears, so.
Right, right.
The first payment of that increased benefit was July of '23.
right, because it was, and I can't remember, it was like $200 a month, and I don't think we went all the way to 4, but maybe we went to 350.
50%.
50%, okay, yeah, so
Yep.
it was,
So the data he would have been presenting would have been
right.
right up to the point before
Right.
it changed too.
I think
to
so, too.
Bradson's point,
The next
you know,
one
if you
will
had
be
him
the-
talk about it early next year, you would have some data around it, but it would be probably pretty modest.
Right,
But you some idea of what's
Just
been
something to
going
keep an eye on.
Yeah.
but I do think it was in the report as a narrative, if nothing else, that,
Okay.
that this was approved. So,
Okay. Any other questions, comments, concerns? Otherwise, I will entertain a motion.
yeah, I move to approve the third quarter investment performance report as presented.
Second.
I have a first and a second. All in favor signify by saying aye.
Aye.
Ayes have it, motion carries.
Okay.
Next up, as always, I think, is recommendations.
Yes, sir. So you'll find that in a single sheet in the back of your performance report book. So just a couple quick things to note before we get into the specifics. Number one, not to scoop the plan administrator report, but the contribution was made earlier this week, the 250. So what you're seeing here is the total assets. Even though we put this together as of the close of business last Friday, we had assumed the 250 in the cash, so it's reflected in the money market fund number below. But what you'll see is, before we get into the specifics, if you look at the bottom left table, again, the asset classes are listed to the left outside the table. The current allocations in black, targets blue, and then in green and red are over and underweights respectively. So you see U.S. equities were pretty decent overweight. Now, given the relative performance over the past 8 weeks or so that I referenced a few minutes ago, in aggregate equities, though, only about 20 basis points or so overweight if you sum up the overweight from U.S. and offset it with the two other underweights. The other kind of outlier, if you will, is investment grade, so fifth from the top. So fixed income after that strong run in Q3, as I mentioned, yields have backed up a little bit here in Q4 for putting fixed income under a little bit of pressure. And obviously with cash, with that contribution coming in at the bottom, we're overweight cash. So if you go back up to the top table and specifically the rebalancing column, as far as the recommendations, there's sort of two broad themes. So up top, we're not recommending pulling money in or out of equities in aggregate, but a slight trim of U.S. equities in the form of $75,000 redemption from the Fidelity Total Market Index Fund within the U.S. and moving those assets to develop non-U.S. So a little bit of trimming what's done very well more recently, buying what's not done so well. So in other words, selling high and buying low. And then within fixed income, basically using that cash contribution to mitigate the fixed income underweight. So 240 grand coming out of the money market fund that you see in the bottom. And of that, 115 going in the Fidelity US Bond Index and 50 and 75,000 going into the Baird Aggregate Bond Fund and the iShares Broad USD High Yield Corporate Bond ETF respectively. The impact of that would be on the bottom right table. So in other words, in aggregate, equities remain about 20 basis points overweight, but we're trimming the U.S. equity overweight to some degree and mitigating the developed non-U.S. equity underweight to some degree. And then the impacts, the others are below, where the investment grade underweight is notably mitigated along with high yield. And then cash is just slightly overweight, as I mentioned earlier, just keeping a little overweight for ancillary fees that are paid throughout the quarter. Everything summarized on page 2 as well, but that is our recommendation, and I will pause there for any questions or comments.
Makes sense. Anybody have any thoughts or?
Concur.
If not, I'll entertain a motion.
I move to approve the plan rebalancing recommendations as presented.
Second.
Okay, I have a first and a second. All in favor signify by saying aye.
Aye.
Ayes have it. Motion carries. Thank you, sir.
Thank you.
Next up is the Plan Administrator Report.
Okay, since the last meeting, we transferred a total of $3,589.28 to pay the RCM&D fiduciary insurance renewal. Annual contribution, as Pat mentioned a little while ago, a second quarter contribution of $250 was made on December 4th, $250,000. Our budget is $1 million, so we have contributed 50% of the budget so far this year. And our meeting schedule for 2025, which is subject to vote, is listed here. The 6 meetings from February 28th, the last one December 5th, 2025.
Well, I definitely want to point out that we are meeting on my birthday, August 29th, so I will expect a very, very favorable report, sir.
And a cake.
And a cake.
And we would need a vote to approve the calendar.
Right.
Yep.
I was just looking at it. Looks fine to me. Anybody have any? If not, I'll entertain a motion.
Move to adjourn.
No, not that motion.
Move to accept the planned administrator report as presented.
Oh, my fault.
I'll second.
I have a first and a second. All in favor signify by saying aye. Aye. Ayes have it. Motion carries.
It's my fault. I set the precedent yesterday.
No problem. I don't know why you're in a hurry, because we're sticking around. Have another meeting. Stay tuned. But now, at this point in time, if there's nothing else, I will entertain one last motion.
Move to adjourn.
Second.
I have a first and a second. All in favor signify by saying aye. Aye. Ayes have it. Motion carries. Meeting adjourned. Thank you.